Bonjour, Francois. Nice to see you.
Bonjour, nice to see you too.
I want to talk about the USA, and it's a good week to talk about the USA because China's on holiday most of the week, I think. Um, Later on, I want to talk about the S&P at 5,000 and how how that can evolve during the year. But first of all, I want to come back to this week. Obviously, CPI is happening. CPI and PPI, and what a ride that's been. 10% to 2% CPI in the space of not very long. I can't remember it going that fast. I'm not quite sure why it's happened so fast. Just a few months ago, Bill Ackman was begging the Fed to reduce interest rates. We have a wonderful employment market. The markets are on their highs. Everything seems to be going swimmingly. Is it going too well? And am I the only person who's wondering if there's no reason to drop rates for the Fed? Maybe that would overcook the economy even more.
Okay,
What do you think?
going to your first point. First, you mentioned the fact that inflation went from 10% to 2.9% expected this week. The main reason is the very, very significant interest rate hike that you experience. It's the fastest interest rate hike by the Fed in the last 40 years. So that's one of the reasons. Also, coming back.
You're talking about real interest rates,
Not
obviously.
only nominal, but also real interest rates. You are right. Real interest rates on the one side, but also the fact that the Fed funds rate were risen so much is very special. Second, you need to remember in 2020, after 2020 and 22, and when there was this issue about inflation coming back, you had this theory that in fact there was temporary inflation. It was connected to supply chain issues and etc. And for quite a long period of time, people said, okay, looking at the way inflation is moving up, it proves that it was not a temporary effect. There is something bigger and etc. At the end of the day, maybe the people who were thinking that there was a lot of temporary effect in the inflation were probably right. You always know after. This is the big issue. So to come to your point, this is the reason why you have such a development. In terms of the way the market and the way the economy is functioning, you have, at the end of the day, when you look at what is happening, I would say that 1 month ago, the main scenario was soft landing. Okay, soft landing for the US economy. It has turned out as something more positive now in terms of scenario expectation. You have some people, more and more people, talking about a no landing scenario, which means that the economy is not even going to be threatened by anything close to a negative growth in the short term. So it's very difficult because you mentioned some points. Unemployment rate is very low. Income are growing, wages are going up. It means that they support consumption. So at the end of the day, does it mean that the Fed has no reason to lower interest rates? There are few reasons to lower interest rates with the current situation. They have no indication that the economy is slowing significantly. They have forward-looking indicators which have evolved quite positively lately. ISM numbers were good last week. We will have this week the Philly Fed Index also. This is something that is very important. We will have the small business indicator that is also a key element for expectation. So Bill Ackman, in a way, was right. There is a point where maybe you should not push the interest rate too far, too long. But for the time being, the Fed is right, and I think that what they did lately was perfectly the right answer. They said there won't be any rate cut in March.
So this is going to wrong foot the market, surely. They are still expecting rates now, even if they're not expecting it in March anymore. They are pressing it in for May. Surely this will wrong foot the market, and this could have a profound effect on the direction of the markets at the moment.
There are two things. I agree with you to a certain extent. You have only 15% of the people who are now expecting something in March. That it would be in May or June is no big deal. The big question that you need to have in mind, does it mean that any monetary loosening is no more in the card for 2024? And that I don't think you can justify. I think that there is a slowdown in the US economy. I think that if inflation is getting closer to the 2% level there are all the reason for them to consider cutting rates, because it means that their mandate, which is not only growth, but it's also inflation, with a target inflation of 2%, or average 2%, I think they have all the cards to say, okay, we can lower interest rates. As long as the market, as long as the Fed and members of the Fed who spoke lately said we need to be cautious in the way we lower interest rates, but they are not saying that they are not going to lower interest rates. And I think that this is the key message for the market. As long as they have this message, the market can evolve, I would say, positively. It doesn't mean that you are not going to face some consolidation in the meantime, but nevertheless, I don't think that it is a real threat. The no loosening is not a real threat for the US equity market.
So your scenario, your preferred scenario, is still that the US economy is not as good as it looks in the figures, and they will need to loosen rates a little bit in order to help the market.
You know, it's not that the economy is not as good as it looks. The economy is good. I judge by the fact. I was surprised by the number. The number were quite strong, and I think that we need to keep that. I still think that there is a slowing down that is going to materialize, and that you have some numbers in the employment numbers that are telling you that there is a slowdown in the employment market. My key point is, don't be stupid. If you are getting closer to 2% in terms of inflation, with the kind of growth that you have no reason to say, I'm not going to lower interest rates, because it means the mandate of no inflation or average inflation around 2% is fulfilled. So you need to do something. Then I will get back to another phenomenon, and the Fed needs to take that into account. Powell spoke about it. Yellen spoke about it last week. It's the real estate market. You know, the real estate market is in desperate need of something happening on interest rates, because you have a lot of pressure. You have pressure all around the world on real estate, in the US also, especially in commercial real estate. We all know that there is a huge amount of money that is currently facing the possibility of default, not only in China, but you also have some ripple effects in the US. You have some side effect in Europe. There are all the reason at one point to consider that you should not be too, I would say, stubborn and not act on interest rates, because you have some fragilities in the economic system, which is real estate, that needs to be dealt with.
I think I'm right in saying that the Fed's mandate is to protect the domestic value of the dollar and to maintain full employment. I think I'm right in saying that. Do they have an obligation in terms of asset growth, inflation, or anything else for that matter?
Many things. First, the mandate of the Fed is to control inflation and to ensure that there is a satisfactory growth in the economy. It's a dual mandate. For example, the European Central Bank has purely an inflation mandate. The role of the ECB is to protect the target that they have set for inflation. The US has a double mandate, which makes them a different situation. So then you have the question, you come to the question of, do they have any mandate in terms of financial assets? Okay, let's be realistic. Since 2008, it's clear that even if they don't have a mandate to protect financial assets, what they have done over the last 15 years proves you that they do something. You know, the famous Greenspan's put and the Bernanke's put and etc., the Powell's, you know, they have something. You know, you have something, a trend that exists since the 1980s, which is more and more financiarization of the economy. This has some positive effect. This has some very negative effect. It's the reason why they take that into account. There is no point in thinking that the Fed never took into account the fact that you had some systemic risk in the system, in the financial system, that needed to be dealt with. That's the reason why they have done so many quantitative easing. They have maintained interest rates so low for such a long period of time. It's not only a question of economy. It was clearly also the fact that the side effect of the finance system having an impact on the real economy that could be so huge, so destabilizing that they had to act.
Has anyone in the Treasury or the Fed analyzed the full problem of commercial real estate and how much this could cost in the worst case scenario? And how much have they estimated it if they
I
have?
read a few things. It seems that, in terms of loans that are currently underwater and that are threatened, you have something like around 200 billion US dollar worldwide that are quote unquote close to distressed or distressed debt loans connected to real estate. And it's not only in the US, it's really worldwide. So it's a significant amount, but the amount of money that is invested in real estate, I read also a number which is close to 1 trillion, and it means that it is significant. Does somebody have the real number? I'm not sure, but you can assess. Those are not small numbers. And I was looking, at statistics, for example, for the worldwide real estate. As I said, potential distressed debt is about 200 billion. The second sector considered, which is software and something else, it's 38 billion. So it tells you the difference between what impact the real estate could have on the economy with other sectors. This is something that people need to really keep an eye on.
Let's go to the S&P 500 now. S&P 500 won 5,000 last week. How can the measurements continue to be stretched in terms of pricing for US stocks? What is the record for stock prices in a downward trend, a new downward trend in interest rates in the US and the world?
I couldn't answer this question, but what I can tell you, if you look at why is the market at 5,000, despite the fact that 10-year bond yield went from 380 to close to 4.2% in a matter of 2 months, which is not a small move. It's a significant move. Despite that, the market has been able to reach this target of 5,000. One of the main reasons, and I think it will remain key in 2024, it's earning per share. Beginning of the earnings season, early January, people were expecting for the fourth quarter of 2023, 1.2% year-on-year growth in EPS. You are currently on a path of 6.5%. 80% of the companies that have reported so far on the US market have beaten expectation. So that is the main reason. You add to that the issue of artificial intelligence, which is driving the market, driving the techno stocks. And it can explain why the market is at that level. Because at the end of the day, with this kind of development in terms of earnings, it means that the P's are not as stretched as they would have been 6 weeks ago. So it explained the market. Does it mean that it goes to 5,002? I still reckon and still believe that there is a need for some consolidation, and that there is a need for the market to give some of the recent gain. It's going too far, too fast, especially considering the level of interest rates. Because, as I said, moving from 3.8 to 4.2 in terms of 10-year bond yield, the risk premium on equity is quite low, and it could be subject to any kind of event that could derail the market and produce a consolidation.
I'd like to talk about commercial real estate at a future date, but not too far away, I think, because it's becoming quite an important subject. So a lot of people are thinking about it. But I think that's all we have time for today. I want to thank you very much, Francois, and I look forward to speaking to you next Monday.
Thank you. You have
Bye-bye.
a good day. Bye-bye.
Bye-bye.